In this week's episode, we are going to discuss what 5 executives from 5 major Wall Street investment firms have said is going to be the potential outlook for 2025 and what you can do to protect yourself from that. Let's roll. Five leading Wall Street analysts recently were interviewed by CNN, and all of them said that they foresee a possible bear market coming in 2025. I'm actually going to read some of it right off of the CNN story right now. First, if you don't already have your own copy of my book, Safe Money Retirement, Your Game Plan for Success, give us a call and get your own copy. It's completely free, no obligation. We will send it to you because we want people to really understand what their options really are in retirement as far as guaranteed income plans or growth with no loss plans or taking care of long-term care or taking care of legacy or all of these things. So give us a call or just log on to our website anytime, safemoneyretirement.com. Get your free copy from there or give us a call, 833-413-SAFE. All right, let's go ahead and jump into this article because there's a lot I want to get through. First, like I said, 5 of the top leading analysts. We're talking about analysts from Moody's, UBS, JP Morgan, Invesco, and Yardeni Research. All of them say there's a good possibility that there could be a bear market this year in 2025. Basically, the chief economist at Moody's, here's a quote from him. His name is Mark Zandi. He said, "I'm very concerned because the stock market is pricing in nothing but blue skies and sunshine forever. The market is very richly valued, bordering on frothy." That's what he called it, frothy, which means overvalued. Zandi also told CNN that he hasn't been this worried about the market since the dot-com bubble of the 1990s and fears a drop of around 20% sometime this year. So my question to you is, are you ready for that? And we're going to talk about that here in a minute, but are you ready for that if that comes? The next one, David Kelly, he's the chief global strategist at JP Morgan Asset Management. He actually agreed. Quote right from him, "I'm worried about asset bubbles," he told CNN. "A lot of castles in the sky have been built on the foundations of this very stable economy. You could have a big correction at some point in the things that are not tethered to reality. There are a lot of very frothy markets out there that could take a shellacking. Investors must think carefully about how much risk they are wanting to take." And that was actually a warning that he said. So I'll ask you that real quick. How much risk are you willing to take? Now, if you're listening to this and you're in your 20s or 30s, you can take a lot of risk because historically the market has shown that it's got overall growth. But if you're in your 50s, 60s, 70s, maybe even 80s, how much can you risk? You've got to determine how much do you have to have in order to live the retirement that you need to live and make sure that you've got that protected, that you don't have to worry about that. UBS also recently sent out a warning to its clients, arguing that many of the conditions of a market bubble are already present. Now, this is Andrew Garthwaite. I might be mispronouncing his last name. I apologize. UBS's global equity strategist in December wrote, "The problem with a bubble thesis is that when the bubble bursts, investors tend to lose 80% of their money. And according to UBS, key bubble indicators include declining corporate profits, heavy participation by retail investors, and a significant time gap of at least 25 years since the last major bubble," which there has been. A bubble happens when there is a narrative of it's different this time around, normally associated with technology or market dominance, and we have both. So there's somebody else that says that there's a potential downturn coming this year. So again, my question for you is, are you prepared for that? What are you going to do to counter that? Are you ready? Is your retirement portfolio ready for that? And on top of that, This is actually something else that I wanted to, but it piggybacks right on this. According to recent data, defaults on U.S. credit card loans have surged to their highest levels since the 2008 financial crisis. In the first 9 months of 2024, lenders wrote off 46 billion with a B in seriously delinquent credit card debt, a staggering 50% increase compared to the same time last year. Now, this is a sign that many consumers, especially those with lower incomes, are struggling under the weight of rising costs and inflation. It's basically the lenders write this off because they know that there's a really good chance that they're not ever going to get this. But what does this mean? If the trend continues, it could lead to a slowdown in the economy, potentially easing inflation, and possibly on the brighter side, actually lowering mortgage rates and inflation. But all of that put together, all of these top market economists, what's going on with all of the bubble, what's going on with the credit cards, what's going on, we can see with our own eyes. My point is, you need to make sure you are ready for whatever's going to happen. If the market goes up, that's fantastic. But what if all five of these experts are right? What if there is a drop of 20% or even more in this coming year? Are you ready for that? Is your retirement ready for that? If you've got millions and millions of dollars, then you probably aren't worried. If you've only got $300,000 saved, well, if you were to lose half of that, that would really put a hurting on your retirement. You need to make sure the money that you absolutely must have for your retirement, you need to protect it, especially the closer you get to retirement. Y'all have heard me say this many times. One of the numbers that is just a general number that we use in the industry is based on whatever your age is, about that percentage of your money should be protected in some sort of a protected guaranteed account. So if you are 68 years old, about 68%-ish of your money should be protected. 75, about 75% of your money should be protected. What do I mean by protected? I mean something that is in a plan that will not go down if the market crashes. Whether that's in an income plan or whether that's in a growth plan, there's multiple different types of plans. But we can put you into a plan that guarantees that no matter what happens in the market, you aren't going to lose a penny. That's what you need to focus on, and that's what you need to make sure when you are approaching retirement, or even more so in retirement, to make sure that your nest egg is going to be there when you need it. On the golf course, one day you can be hitting them perfectly. The next day, in the water back there behind me. You know, retirement can be a lot like that with the stock market. You think you're doing great, you're having great gains, then all of a sudden there's those losses that come in. And we're talking about what you have saved your entire life for. Well, what if I told you there was a way to get past that? What if I told you there was a way to protect everything that you've saved over the last 30, 40, 50 years and never have to worry about market losses again? What if I told you there was a way for you and your spouse to get an income you cannot outlive? What if I told you there were some long-term care benefits built into these products? Well, I can show you how they work, and you can see for yourself in the free book you can get below, Safe Money Retirement, Your Game Plan for Success. I wrote this for you so you can understand what you can really do to protect your retirement. My dad lost over 75% of his retirement in the first 4 years he was retired. I do not want that to happen to you. Download this free resource, and we'll be in touch. In today's case file, we're going to look at a very unique situation, and this was with Henry and Sally. Henry and Sally came in to see me. They already had a lot of things taken care of in their retirement. Henry had a substantial amount saved. So they were basically self-funding their retirement, and with the amount that he had, it's pretty safe. They already had guaranteed income, and they had plenty to cover their expenses because they'd paid everything off, so their expenses actually were quite low. They already had life insurance to cover things. They already had growth plans. They basically were all set. The one thing they didn't have was something to take care of long-term care if that ever popped its ugly head up. And as many of y'all have heard me say, just in 2022, a congressional committee actually came back and showed that over 70%, that's 70, over 70% of people over 65 are going to need long-term care at some point. So he came in and we were looking at different options. Now, getting a long-term care, a regular, old-fashioned long-term care policy, you would want to do that in your 30s, 40s, maybe early 50s. They were already in their early 70s. So getting a traditional long-term care policy wasn't a real smart move for them because it would have been extremely cost prohibitive and the benefits, and the rates would have just kept going up. It wouldn't have been a wise move. So what we actually looked at and did for them was an asset-based long-term care plan. And what it actually was a life insurance plan that was a single premium. They just paid a chunk and it was paid for, so there were no more payments due ever. A single premium life insurance plan that had a long-term care benefit built into it. Now, I'm not going to say the exact amount that they used, but I'm going to give you an example. This particular plan, if you had put $300,000 into it, well, if you never use it, then congratulations, someone's going to get a $300,000 death benefit when you pass. But if you need to use it for long-term care, that $300,000 doubles to $600,000. So you now have $600,000 in benefits that you can use specifically for long-term care. That's what we did for them. They left so happy and so relieved because, as many of you have probably seen from your friends and family members, long-term care is a major thing that can really suck resources because the average right now is between $8,000 to $10,000 per month for long-term care. Now, I don't care how much money you've got, $8,000 to $10,000 per month adds up real fast. So that's what we did for them. Now, how does this relate to you? Maybe you need to take care of long-term care and make a plan for long-term care. Well, what we can do is we can sit down. My company actually has multiple things that we can do. If you're on the younger end, or even if you're slightly older and are in really, really, really good health, maybe a regular long-term care plan makes sense for you. It may very well, and we can do that. Or there may be some type of an annuity with a long-term care benefit that might make sense for you. There are income plans that the income can double as long as there's money left in the principal. There are growth plans that allow you to get to all of the growth if you get in a long-term care situation. Or it may be what we did for the clients I was just talking about, and get you set up on a life insurance plan that basically is going to pay a life insurance benefit. So there's really no downside. The worst thing that happens if you don't ever use it, it goes to whoever you've named as your beneficiary. But if you do use it, you can basically do a multiple, and there's some that do too. And if you're in really, really good health, you might even be able to qualify for 3 times what the principal that you put in that you can use as a long-term care benefit. So just make sure that you get with a certified financial fiduciary. Make sure that you look at what your options really are for long-term care, because again, for over 70% of us, once you hit 65 and older, 70% of people are going to need long-term care at some point. So what's your plan for it? Make sure you've got a plan. Make sure it's a solid plan. Make sure it's one that you can count on, one that's guaranteed, and one that can make sure that long-term care doesn't derail your retirement.